And welcome to this week's edition of the Swyftx Squawk. I'm Pav, lead market analyst here at Swyftx, and this week we're back at it again. A little bit more of a macro-heavy edition of the Squawk. I think this one's a really important one because it helps tie together just a whole risk story that we've been following for the last couple of weeks and months, to be honest. It's all played out pretty much down the vein of what we were thinking. Just as an update, we have been thinking about how our policymakers looking at the current state of the economy, especially with the inflation rising into the middle of this year. We followed how that was likely just an impulse by the energy markets as we did see oil prices surge. Now that we've seen that cool, we've seen a single print of inflation come down. But interestingly, on Friday night, while we're all sitting down to relax and enjoy our weekends, the US released its latest round of job figures, and this is really important. This is something that we've been speaking about on the Squawks for quite some time, about how policymakers are essentially balancing two things, right? Growth and employment on one side and inflation on the other. That's the tightrope that policymakers are walking on to steer economic policy changes. And that's important when you think about risk assets, because risk assets like crypto, they perform quite well when there's lots of money and liquidity in the system. They do quite poorly historically when that money is out of the system and there's less money going around. So usually when we're looking down the barrel of potentially a slowdown economically, it can mean two things. It could mean a short-term impulse of prices maybe finding it harder to move any higher, even falling to some degree, which we have seen in the past. But then it also opens the door for where we could see economic response to potentially a job market, which, just to run through the figures, we saw 23,000 jobs rolled off in July. So a bit of again, less jobs than expected in the market. When I think 80,000 were expected, we actually got a negative figure. But on top of that, if you actually dive into a lot of the data, which I do, these job figures, they can be revised a couple months later. And this is where things get a little bit more interesting. We saw the June and May revisions now show a combined 103,000 lower jobs than previously reported. This is something I don't know if the majority of the market is looking at right now, but in the sense of we've been concerned about inflation going higher, that's now coming lower. The job market's been absolutely soaring and the growth market has been absolutely soaring too. Some of the forecasting platforms out there, like the Fed Bank of Atlanta, they do a nowcast. It's currently sitting at about a 5 to 6% rate of GDP. That's huge. It's basically saying that there is currently quite a bit of growth priced into the market. What does that look like now if we start to see this sort of become a new trend where we see jobs actually falling out of the market and we see potentially wobbles in that employment market? That's kind of a concern for the market that we'll be tracking quite closely as we move forward from here, particularly as we also have the next round of inflation data coming in on the 12th of August. So that is tomorrow, a Wednesday, at about 10:30 p.m. AEST. And then importantly, we also, as a part of this idea and this thesis that we're playing out right now, on the 26th of August, again on a Wednesday, 10:30 p.m., we have the next update to the GDP figure for the US as well. So that's when we get our next snapshot of what's that growth figure looking like. And again, this is now a one print now, but it has become a trend because of the revision, that the trends do matter. This is now something that may require a bit of attention from policymakers and, more importantly, the market. Because as we've found from hearing about what the policymakers have to say this time around with the new Fed chair of Kevin Walsh at the helm, he's more interested in how the market is thinking about the state of the economy to drive economic policy. So this is a big difference from the regime that we just come out of with previous chair Jerome Powell. And what we can see is that since these data prints have come out, this is a basically the market's probabilities of how the market's thinking about interest rates heading into the last economic meeting of the year, which is the 9th of December. The gray line here is essentially the current benchmark that we have. And the green and the yellow represent both a 0.25% and a 0.50% interest rate raise. So the market's expectations that we're going to see a raise. Now, we can see since May, there was a huge increase in the market thinking that we were going to see the probabilities of an interest rate rise come to fruition. For the first time, really, in the most recent times, we're starting to see that expectation roll over. And this is going to be an interesting one to watch as well, because obviously, if the market's already thinking ahead, thinking they can't possibly increase interest rates into a somewhat cracking employment market, that could be a big sign from the market that could impact Bitcoin and crypto prices as we head into the back end of this year. So I think that's one way to really think about it. Very simply, if there are less and people being employed in the market, that could put a bit of stress on the availability of capital flowing into assets like crypto, like equities, like anything else really. And really, it's just another part of how to view how the market is potentially moving right now. What are the drivers, particularly as we look at a chart of Bitcoin? This is a chart that we've been following on the Squawk for quite some time now. From the lows of July, we really have been up almost double digits for the majority of the last couple of weeks, currently sitting about 12% up. But we still have structurally failed to make that new higher high, right? That's currently something that we're looking at as a bit of a tell of, has there been more buying than selling? Was the market going higher rather than lower? And now seems to be forming what could be potentially a lower high, which sort of continues our downtrend here on the chart. So this could change at any point in time. But again, we're tracking what it's doing right now. And it seems to be a fair bit of selling into these highs here. So I think this would be very important to watch as well as we start to see some of these data prints come out, because it'll give us a very good indication of how the market's thinking about what's happening in the broader scheme of things and how that relates back to risk assets like crypto. So I hope that's been helpful, guys. We'll be back again next week to break it all down. But thanks for joining us today. Cheers.